operations and the future plans for the business. Before we begin, I do want to remind everyone that the discussion today may include forward-looking statements that could cause actual results in the future to differ from expectations. We do encourage you to read the published quarterly results alongside the audited financial statements for the year ended August 2024, as well as the management discussion and analysis. The documents can be located on the Jamaica Stock Exchange website, as well as the investor relations section of the SYGNUS Group's website, which is www.sygnusgroup.com. I will now go ahead and introduce our presenters for today's session. We have our Chief Investment Officer and Executive Vice President at SYGNUS Capital, Mr. Jason Morris, as well as Vice President and Head of Real Estate and Project Finance at SYGNUS Capital, Mr. David Cummings. Following the remarks from Jason and David, we will be taking questions. So we are encouraging our attendees to participate in the session today by submitting their questions using either the Q&A feature within the Teams platform or YouTube or via email. And the email address is srf@sygnusgroup.com. So at this time, I will turn over to Jason.
Thank you, Justine. Good morning, everyone. Happy Tuesday and happy pre-Easter. Just be safe and don't eat too much butter and cheese, right? Okay, so as usual, really want to thank shareholders and prospective investors for coming on this call. And as is customary, as Justine would have referenced, please take these financial results and this discussion in the full context of the audited financial statements, which has a lot of notes to the financial statements to help you to understand the mechanics of how this business operates and how it has been performing. That being said, we can jump right into it. First thing that I want to do is just to go through a number of major milestones / achievements that would have occurred over the first half-year period as well as during the second quarter. So first new thing that would have happened is that SYGNUS Real Estate Finance would have taken a strategic decision to increase its stake in the One Belmont office tower. So if for recollection, the One Belmont office tower is owned through a joint venture where SRF would have owned 70% of that joint venture prior to now. During the quarter, SRF would have increased its stake by 16% to get that stake up to 86%. And so, you as shareholders now own 86% of the One Belmont office tower. So that's a good thing. And that increased stake actually would have benefited shareholders in another sense, apart from owning a larger stake of a very wonderful income earning generating asset. It would have also resulted in a one-off gain that would have positively affected the financial statements, which we'll go through when I get to that section. Second thing I like to highlight is the activity that would have happened during the half year. SRF would have deployed 1.39 billion into new investments, and at the same time would have exited 1.72 billion in the first half year. So we are obviously transitioning between the end of the first investment life cycle and the start of the second investment life cycle, which we have been speaking about now for 2 quarters running, or maybe 3 quarters running, right? And we had said that investment activity would have slowed down at the back end of the last financial year, but then as we go through the start of the second investment life cycle, you will see activity starting to ramp up. So the first 6 months of the financial year, you'll see where we're having activity on both sides. We're exiting investments and we're also deploying new capital. And as we go through, we're going to see more and more of activity ramping up um, and increasing. Third thing I want to highlight, which we spoke about on other earnings call, but this is the first official notice, so to speak, because this actually happened during the reporting period. So the first dividend, SRF would have paid the first of what we hope to be many more dividends during the second quarter on December 30th, 2024, and the dividend rate was 0.2012 Jamaican dollars per ordinary share. Fourth thing, and perhaps the most important thing for shareholders, is I think I spoke about this for those who would have been at the annual general meeting. I would have introduced a new return metric, and at that time I would have used residual value to paid-in capital, which is a term that is a calculation that we use to track performance of private investments, right? And SYGNUS Real Estate Finance is doing a lot of private investment, especially in liquid assets. So what I'm trying to highlight here is what is the return that SRF has generated and the share capital that investors would have put in the company. Now, this term is total value to paid-in capital, and the reason why it's slightly different from residual value to paid-in capital is that total value to paid-in capital, you include the dividends that are being distributed to shareholders. So effectively, what we are doing is looking at the amount of equity capital that investors contributed to the company, look at what that value has grown to, both from a realized and unrealized perspective, including any dividends that have been returned into the hands of shareholders. And that is how you calculate what the return or a return multiple that would have been generated. So given that we would have paid the first dividend in December, we are finally able to calculate total value to paid-in capital multiple. So 4.2 billion is what investors would have given us, I think, in terms of equity investment into SRF. And over the last 5.5 years, we have increased that value 1.68 times. So we're going to continue tracking this ad infinitum, and at some point we'll create a graph of it and show that. And that's one return metric that we always want to be showing shareholders, and that shareholders should absolutely be judging SRF in terms of performance metrics. So I know that this is kind of new, and it might take a while for everybody to get up to speed with it. But if you want to, you can also research that by just simply Googling the term, and you'll see how the formula is comprised, and that this is one way for you to measure whether or not SRF and the fund manager are being good stewards of the capital that you as shareholders would have given us. So with that out the way, let's get into the performance for the second quarter. So as I mentioned before, which is, I guess, people might say this is a welcome positive surprise, right? Because normally SRF is quarterly interim financial statements are typically very lumpy, with majority of the time reporting negative net profit, and then that convert into a different story at the end of the financial year. However, in this instance, SRF would have generated a net profit of 38.24 million versus a net loss of 187.15 million for the same similar quarter last year. And the main driver for this was due to the strategic acquisition of the additional stake in One Belmont during the quarter, which would have resulted in a 162.2 million gain. Likewise, that event would have also positively impacted total investment income, which was 152.25 million versus the loss of 24.35 million for the same period last year, and net investment income 66.75 million versus a loss of 113.22 million for the similar quarter last year. Earnings per share positive 12 Jamaican cents versus a loss of 57 Jamaican cents for the same quarter last year. And then book value per share would have been up to $24.05, up 5% versus $22.91 for the same period last year. Again, just want to highlight from a return metric, two return metrics that we are following. Total value to paid in capital, we have taken the capital that shareholders gave us and increased that by 1.68 times over the last 5.5 years. Another return metric is the return on average equity, and that was 19.15%. But that measurement is through the end of the financial year, ended August 2024. So from inception to the end of the financial year, August 2024, return on average equity is 19.15%. We're not measuring it to the end of the 6-month period because the 6-month financial results, as you'll see on the next page, is negative. So, on to the 6 months results. SRF would have, the net profit would be negative 197.45 million, which is an improved performance versus the negative 320.13 million in the same 6-month period last year. I think there's an error there that should well, it should say 6 months, but at the end of the second quarter last year. Total investment income would have been 26.59 million versus negative 55.31 million for the 6-month period last year. And net investment income was negative 160.21 million, an improvement on the negative 228.1 million at the end of the 6-month period last year. Earnings per share, negative 60 Jamaican cents versus negative 98 Jamaican cents at the end of the 6-month period last year. So that is an improvement. And whereas the book value would be the same as at the end of the quarter, $24.05 versus $22.91 for the same period last year. And I would have already spoken to the two return metrics, so I won't repeat myself here. Looking at the financial statements itself in terms of how we represent that information, which is in a slightly different format from how it is reported in the actual financials themselves. And this methodology, which we have been reporting since the company would have started reporting as a public company, is to give investors a better handle on the performance of the company versus how the financials are required to be reported by the auditors. So the first thing I want to highlight is net interest income, which you can see that for the quarter and for the 6-month period, net interest income would have been much higher than the quarter last year and the 6-month period last year. And simple reason for that, right? We would have been using a lot more debt to finance deployment of capital. But that debt that is funding deployment of capital, the capital itself, there's a different timing difference between when the debt would have been raised and when we are investing that debt into interest-bearing or interest-generating investments, one. And two, some of the debt is being used to invest in non-interest-bearing assets, so assets which are going to generate fair value performance. So we will see an improvement as we go through time, as the real estate investment notes, which is the primary means by which SYGNUS Real Estate Finance generate interest income, as that goes up over time, as we deploy more and more capital into that sub-asset class. Second thing I want to highlight on the income statement is the gain on acquisition of shares in joint venture. That 162.196 million is reflective of the increased stake in One Belmont, which is a very good strategic positive for SRF and for shareholders. And the other thing is just the fact that you can see the net profit for the quarter, and I said before that is really and truly down to the increased stake. As is per normal, and as we normally say on these calls, that SRF financial statements are very lumpy because the valuation of its assets are primarily investment property held on the balance sheet or joint venture, and those really get valued once per year. So you really see the true reflection of what's happening on the income statement come financial year end. But it's always good to have a quarter with a positive performance, because that increases the likelihood and probability of positive performance at the end of the financial year, although nothing is really guaranteed. So moving on to the balance sheet, as at the end of February 2025, shareholders' equity would have been 7.85 billion, up from 7.48 billion in a similar quarter last year. And while total assets would have been 15.19 billion, roughly flat, down 0.2% versus 15.22 billion in the second quarter last year. And total assets would have reflected, on one hand, the fact that SRF would have exited quite a large amount of assets, but at the same time, it would have raised new capital and invested in new assets. And so the exit would have kind of offset the new investments, and so that's the reason why the balance sheet pretty much has remained kind of stable. However, given that we have introduced a new term, I just want to one more for the third time, right? Show total value to paid in capital of 1.68 times. So it's shareholder equity, which is actually 4.72 billion, that's shareholder paid in capital, and would have increased that value to 7.92 billion. Now, this 7.92 billion, right, is equal to the total value of the shareholders' equity that is reflected on the balance sheet, 7.85 billion, plus the capital that we gave back to investors in their hand. And if you recall, we would have given back to investors in their hand some dividends in December, right? So that's 65.7 million in dividends that we would have given to investors when you take the shareholders' equity, which is the residual value, 7.85 billion, and take and you add the dividends that we pay, then that gives you the total shareholder value. And you divide those two numbers, you get 1.68 times. So as we go through each quarter, we keep going, we're gonna continue to explain and update this return metric, which effectively is showing you that if we were to effectively liquidate all the assets on the balance sheet, right, and liquidate all the liabilities on the balance sheet of SYGNUS Real Estate Finance, ceteris paribus, everything else being held constant, then the capital that investors would have given us, meaning the capital that investors would have put into the company during the IPO, after we pay off all the debts, the liabilities of the company, and we extract the value from selling those assets. Of course, net of whatever costs would exist in selling off the assets, then we are saying that the value that would remain to shareholders would be 1.68 times. So it's very important for us to report this to shareholders and for our shareholders to get a very good appreciation of this value, and so that we can kind of demystify the illiquid nature of real estate assets and what the value really is, which is very different from the stock price of the company, which the stock is, I think, 50% or thereabout discount to the actual value that shareholders have or that the company has built up over the last 5.5 years. So just want to, kind of provide additional information to investors so that they can make the right type of decisions as they are looking at real estate assets and ways to get real estate exposure. Next slide is just speaking about how we manage the company in terms of the efficiency ratio. which is effectively just looking at management expense ratio first off, which is really looking at operating expenses as a percentage of total assets under management. And what we want to strive for is to maintain that below a 3.5% threshold level. And as you can see at the end of the Q2 2025, we were at 2.5%. So we were, 1 full percentage point below the threshold level. Why is this important? Well, it means that where the company isn't operating in a wasteful manner, right? So every dollar that we're not taking the assets under management and spending a lot of it on operating expenses, which means that we have more money left over to pay dividends as well as to generate positive profit for the company and enhance free cash flow. So that's very important. The efficiency ratio, which is operating expenses to total investment income. We normally assess that at the end of the financial year. Why? Primarily because the lumpy nature of SRS financial statements means that we typically don't have a positive total investment income number to report, which is what we need to create the ratio. However, as you can see at the end of the last financial year, the efficiency threshold limit was 45%. Well, that's the threshold limit, and we were at 39.4% at the end of last financial year, just for comparison. Turning to investment activity, at the end of the Q2, investment assets would be 14.82 billion, down marginally from 14.96 billion at the end of the same period last year. Again, this is due to the fact that we are in a transition period, and so we are doing a lot of exits. At the same time, we are ramping up new investments, right? So we would have explained this for maybe the last 3.5 quarters that we are in a transition period, which we continue to be at the moment. Total property investments, 10 billion versus 11.59 billion, again, reflecting the fact that we would have exited a number of property investments as we came to the end of the first investment life cycle, heading into the second investment life cycle. Of course, you will see where we will add new property investments in future period, because what we basically did was said, okay, during the first investment life cycle, we invested in these properties, and if the best decision was to develop property A or B or C, generate some return for shareholders, or is it in our best interest to accept a very good offer on a property investment, make some returns, and then take that as that cash and go and put that into a new investment with greater prospects for generating a better return. We are agnostic, right? We are real estate investors. We are investing the money to generate the best return for investors through any means necessary, whether that be we do our development with it, or we sell it and make a gain on it, or we take the money and invest in a third-party real estate investment project. Speaking of third-party real estate investment project, the value of that was 2.73 billion on the balance sheet versus 1.83 billion at the end of the same period last year, and this would be reflective of new investments that would have made to would offsetting any exits that would have had during the period. And in terms of the value of joint venture investments, 2.52 billion, up from 1.54 billion for the same quarter, for the same period last year. Again, primarily reflecting the increased value in the gem in the crown jewel, One Belmont, as well as another two other JVs that we have. And finally, exits 1.72 billion versus 388 million for the same period last year, again reflecting the fact that exit activity would have ramped up as we got to the end of the first investment life cycle. Now we have dry powder on the balance sheet of 95.94 million versus 38.21 million at the end of the same period last year, reflective of capital that we would have raised over the last 6 to 9 months, which would have then been redeployed into new investments. Next slide, speaking to investment allocation. I won't spend a lot of time here other than reflect the fact that we are well diversified across different investment categories, and we are diversified in terms of um, trying to enhance our exposure to joint ventures, real estate investment notes, but investment property is still the largest part of our exposure, representing almost 2/3 of the assets on the balance sheet. And what this really reflects is that this effectively is showing the undeveloped value of those assets that are on the balance sheet, which we continue to work our way through the various stages to get these assets to enhance and unlock that value. Speaking of these assets, the next slide is showing a summary of the key strategic assets on the balance sheet. You will see the RDA joint venture, which holds one Belmont, and we spoke about the fact that we now are up to 86% in that asset, up from 70% previously. Charlemagne Holdings, now here at the end of the quarter or during the period, we would have exited Charlemagne Holdings, or rather would have exited the asset that was originally under Charlemagne Holdings, which was the Hillcrest asset. We would have sold that to a third party, and then we would have done a transaction where we would have taken one of our other assets, which was in a joint venture, and put that underneath Charlemagne Holdings. And this is the reason why, despite the fact that we would have sold the Hillcrest asset, which was held under Charlemagne Holdings, you are still seeing Charlemagne Holdings and represented as part of the strategic assets. So just to clarify that, to be very clear on that, is a different real estate property that is now under Charlemagne Holdings, right? A 1 acre residential property that we have. Everything else remained the same as at the end of the financial year. So I won't spend too much time there. What I want to do, though, is to invite David to give a brief overview on some of the strategic assets that we have on the balance sheet in terms of what we are doing and where we are. David.
Thanks, Jason, and good morning, everyone. The first you see on screen is the One Belmont project that Jason alluded to a few times during his presentation. Clearly, our Class A building now is in full operation. The first tenant has already moved in, and the second tenant is preparing to do so before long, as you can see there on screen, during the first half of the calendar year 2025. The building continues to perform and meet our expectations. As you can see there, 99.7% complete. And why is it saying that as opposed to 100%? Simply because as we ramp up the occupancy, we are continuing to fine-tune the various systems in the building. There's a building management system, the access control system, the standby power systems, and so on. They continue to be commissioned and fine-tuned, as well as minor cosmetic touches such as the completion of the landscaping and so on. So that's why you're seeing the number on screen reflecting 99.7% as opposed to 100%. Next slide, please. Mabey Bay, again, this is our flagship beachfront property. We'll all be aware of the continued growth in the tourism segment. So of course, this is continuing to present us with significant opportunities, and we're making good progress on discussions with our partners. And hopefully before too long, we should be able to report to shareholders exactly, which decision we have made in respect to unlocking the value for our Mabey Bay asset. And the last slide, of course, is to do with our Lakespan project. Next slide, please. Which is our 55-acre industrial property out in the Lakespan area. As you can see there on screen, just to the southwest of the Wisinko building, there's the white building you see on screen. The blue triangle represents the 55 acres of our property. And as you can see, the design is in progress. In fact, the design is almost complete. So we are actually on schedule and making very, very good progress in terms of how we unlock the value here. So the designs are almost complete, and we are on target for the commencement of construction early in 2026 calendar year. So that's it on the update on the projects. I'll now hand you back to Jason.
Jason, you may go ahead.
Okay. Thank you. Oh, you guys muted me. Okay. Thank you. 4 key pillars of the strategy that I want to highlight some updates on. The first one is simply to execute key strategic initiatives. David would have mentioned what we are doing on One Belmont, so I won't really provide any update there. And he also provided an update on Mammy Bay and Lake Spin, so I won't explain anything there. Third point here on the strategic initiative is to deepen access to flexible capital. What do we mean by that? Well, there are quite a number of different valuable real estate assets in various locations in Jamaica, as well as across the Caribbean. And we are looking at quite a number of these in relation to co-developments or partnerships, or to do income generating real estate investment notes. So one of our mandates is to ensure that the real estate sector gets access to financing, and SYGNUS Real Estate Finance is in this business. But just to be clear, we're not trying to compete, for example, with banks, right? As you can see, what we want to do is to do co-developments or joint ventures or real estate investment notes. So we are not necessarily trying to deploy capital similar to what a bank will do. What we'll do is partner with in many instances, partner with banking institutions who provide the if required, senior bank financing for a large project. But we provide this service to the market, and we are looking at quite a number of opportunities across, not just in Jamaica alone, but across the region. Portfolio realignment would have made substantial strides in that regard. We would have monetized some of the assets on the balance sheet over the last 9 months, and where necessary, we will continue to do so. Of course, we are going through the first investment life cycle overlapping with the second investment life cycle, and we would have temporarily reduced management fees from 2%, which is where it's normally, to 1% in the last financial year. And in the current financial year, the management fee reduction is from 2% to 1.25%. And we have done this because we recognize that as we go through this transition between the 2 investment life cycles, investment activity will slow down. And as a result, being responsible investment managers, we took that strategic decision to show that we are very aligned with the interests of shareholders. And this is nothing novel or new. This is what happens with investment managers in international financial markets all the time, right? So we are just following best practice. Finally, we have asset workouts. We have 2 assets that are in workouts where we have the underlying development as our investment collateral, and we continue to work through the workout process with those developers and to ensure that we get a return of our investment. So second pillar is to expand our footprint in other Caribbean countries. I think we have maybe 6 or 8 prospective transactions looking at. I know that David has probably 2 dozen, right? But maybe 6 or 8 that I would say are in high probability to medium probability transactions that we're looking at. So we're really looking at, what's the best transaction to make that first foray in the Caribbean, in the wider Caribbean, because SRF was developed as a Caribbean investment vehicle. We just chose strategically to spend the first 5.5 years in Jamaica based on the value creation that we saw in Jamaican real estate assets, and because Jamaican tax laws would have changed, I think in 2019, which would have changed the real estate investing landscape tremendously for an investment firm like SRF. Third thing, dry powder, which is a constant. You invest, you harvest your investment, and then you redeploy your capital, which we would have done during the last financial year, and we are continuing to do in this financial year. And of course, we would have raised a substantial amount of capital during the last financial year and the first quarter of this financial year. That's an ongoing activity that all investment firms have to do. And so far, so good for SRF. And finally, return capital to investors. And we spoke about the first dividend, which we hope is the first of many. So I want to close out by saying the work that SRF has been doing to unlock value for real estate assets, primarily in Jamaica so far, and looking to the future, the rest of the Caribbean, and the performance of the company in terms of increasing the capital, paid in capital by equity investors, 4.72 billion Jamaican dollars, increasing that by 1.68 times in 5.5 years, and generating, based on the audited financial results to the end of August 2024, which is the first 5 years of SRF operation, generating a return on equity of 19.15%. Those two performance metrics speak for themselves, and we are pushing very hard to continue to unlock additional value for shareholders and pushing very hard to ensure that we can continue to pay dividends on a consistent basis. And we hope to have new and exciting things to report in the not too distant future on developments that SRF is working on, and ways in which current investors and prospective investors can participate in long-term dividend generating investment opportunities that SYGNUS Real Estate Finance will bring to the market. So continue to look out for those. As usual, we will give you lots of information well in advance and communicate appropriately. I think this is I want to end the presentation here by now moving to taking some questions for clarity.
Thank you, Jason and David, for those remarks. Very detailed presentation, not just covering the performance, but also going through asset by asset. So at this time, we'll move into the question and answer segment of the session. I'll start off with the questions that we have on the Teams chat. And the first one is in relation to One Belmont and Adair. Was the 16% increase in One Belmont or Adair Holdings acquired from DC Tavares and Finson Company Limited, which is a joint venture partner?
So thanks for that question. So the answer to the question would be yes, given that there are only 2 joint venture partners in One Belmont.
All right, thank you, Jason. All right, so our next question is in relation to Belmont as well. Does SRF intend to own 100% of Adair or One Belmont?
Do we intend to? Well, let me put it this way. If another opportunity arises for us to increase our exposure we certainly would like to take it, but it's highly unlikely that will happen. Plus, when we think about One Belmont, we are in the process of working through how we are going to partially exit the assets. So yes, we increase our stake strategically. Obviously, one never turns down you know, an investment opportunity. But at the same time, we're also looking to the long term or medium term partial exit from One Belmont, which effectively means we are seeking to allow what I want to call investors to participate alongside the two partners in One Belmont to and thus participate in the income generating capacity / the cash flow that One Belmont is generating in the near future. So from that perspective, we're not really looking to increase our stake to 100%. But if the opportunity arises, we certainly would do it. But at the same time, I'm saying obviously we are also looking to partially monetize part of our Belmont investment over the medium term, which will give shareholders and regular investors an ability to participate in One Belmont, which would naturally mean that we wouldn't own 100%. So what I'm saying is that over the medium term, we certainly aren't going to hold 100% because part of our strategy is we invest, we create value, unlock value, then we need to monetize, meaning we need to get back some cash, which we can use to pay dividends and redeploy into other assets while still holding a substantial portion of the asset to generate income to maintain dividends over time, right? So I hope I haven't provide a confusing answer. If I have, you can ask it in a different way or ask clarifying question.
Thank you, Jason. All right, so we are moving to Lakespan. When is Lakespan expected to come to the market, and will it be listed in the public market? So that one, I believe, may be for David.
Sure. Thanks for the question. So we are completing designs now. From a regulatory standpoint, we can't bring it to market until we have real estate board approval. And real estate board approval typically or usually comes after we have gained the approval from the St. Catherine Municipal Corporation. So our best estimate right now is that we'll have those approvals in place towards the later part of calendar year 2025 in terms of the Paris Council approval, as well as the real estate board approval, and that's when we'd go to market with the product. And subsequently, as indicated during the briefing, we are likely to commence construction or on target to commence construction very early in the calendar year 2026.
Thank you, David. All right, so we are moving to the real estate investment notes, questions in relation to those. And the first one is in relation to Ocean's Edge. What is the update on Ocean's Edge, the latest update on Ocean's Edge, sorry, and what exactly is SRS role?
So the latest update is that we are going through the workout, right? I don't want to. I'm just trying to parse my words. So effectively, the asset obviously is in the construction. The developer didn't get to complete the construction, and we would have exercised our rights to ensure that we protect our investment capital. from the perspective of persons who would have made deposits on the property, I believe all of them would have gotten back their deposits, and so the property is now going through the normal process that you go through when an investor like ourselves has it as collateral as we seek to recoup our investment in the asset. So the good thing is that because the property, obviously, all depositors have been repaid, then from that perspective, that increases the degrees of freedom in terms of the various things that we can do to recoup our investment. And so that's what we are doing. We are working through a process. I don't want to say too much more than that. We are working through a process to recoup our investment capital. And that means basically we are assessing all our various options. And so that's where we are at the moment.
All right, thank you, Jason. So we have a question in relation to 26 Seaview. The property at 26 Seaview currently has a sold sign by Catalyst Realty, and the building on the property was removed or knocked down. The Q2 financials state that this asset was reclassified to investment properties. Is it that SRF would have sold this during the quarter or during the subsequent quarter, Q3? And if so, what was the sale price for the benefit of all attendees and shareholders? I will hand to Jason, and then yeah, I will hand that one to Jason.
Yeah. So let me put it this way, right? That we are part of our job is to monetize assets that are on the balance sheet, and we have monetized that asset. Obviously, I can't speak to anything around sale price at the moment. That's all that I'll comment on that until I can provide additional update.
All right, thanks, Jason. We have a few questions in relation to Belmont. All right, so this one is also in relation to the recent acquisition of shares. Did the purchase of the shares in Audia represent a capital injection into the JV subsidiary to complete any final activities, or was this a partial exit for the other JV partner?
Very good question.
Yeah, you could go ahead.
Excellent question. So it's definitely not a capital injection. There's no capital to inject to do anything, as David would have eloquently reported earlier. 99.7% complete, right? Which means that it's done. Just some few cosmetic things to do. So effectively, the JV partner reduced their shareholdings and we increased ours. So it's a straight exchange of shareholdings, straight sale. So for want of a better term. So doesn't have anything to do with the development itself. It's just a strategic decision by us based on what the other JV partner wanted to do. And we feel it's a very good deal, and we took the good deal. Both parties are happy. So we're making money for shareholders, so we are happy. That's what it was about. Nothing to do with there are no costs left to spend on One Belmont, effectively.
Thank you, Jason. And there was a part 2 to this question. I just decided to split it because it was so long. What does the timeline look like for the remaining tenants to complete their build out and take full occupancy?
Very good. Yes. Very good question. So each occupant, right? The timeline for their build out varies. It all depends on when they want to complete or what strategy they have in terms of doing their build out. So it varies, right? But the way we have structured the building is that effectively lease the lease payments have trigger dates when they start. So it is up to occupants to effectively manage their build out and do their build out as they see fit. That's the best way I can answer the question. It all depends. Each person has their own timeline for when they want to complete their build out.
So the next question, thank you, Jason. The next question is in relation to the 16 Montrose property. I believe this may have been discussed, but I will still go ahead and repeat the question so that we can have some clarity for the attendee. Did SYGNUS Real Estate Finance fully acquire the Montrose Road property due to the winding up of the Monad Royce JV?
That's correct.
And we have another question in relation to the newly formed joint venture in St. Anne. The 71% new joint venture in Landfall Ocherios is set to be residential development, so we can go ahead and confirm that. What are the timelines looking like as it relates to getting this joint venture underway?
Well, I'm not sure if David, you want to take that question?
Sure. Thanks for the question. We are in the midst of doing our studies on the best way to unlock the value. So at this point in time, to give a timeline, it would be only an approximation. As you will be aware, the gestation period for projects of this nature here, from concept to getting approvals, is probably going to be about 12 months. But as of this moment here now, clearly we have not made any decisions about exactly what the development will look like. Suffice to say that we will report back to shareholders and investors in due course once we have clarity on the optimal way for us to unlock the value. It will involve a number of studies. It will involve a number of permutations, a number of financial models as we go through to ensure that we optimize the value that we can unlock on this particular property here in St. Anne.
Thank you, David. So based on the time, we're going to take 2 more questions. And if it is that we're not able to address your question today, please feel free to send us an email, and I'll repeat the email at the end of the session. The next question is in relation to the preference shares that were issued by one of the entities within the group. The redemption of the 551 million preference shares represented a debt-like liability to the former owners of the Hillcrest property, or were the preference shares attached to a previous debt facility that was closed out on sale of the Hillcrest property?
So very good question, right? Let me answer the question this way. So when we look to finance transactions, we try to use as much innovation as possible to structure the investment. So in regards to Hillcrest, effectively what we did, we basically structured the financing of that in a unique way by having what I'm going to classify as a type of co-investor where we cap their upside returns. And so that preference shares was in relation to that investor. So it's basically a way to fund that we fund. It's basically a funding mechanism for the acquisition of the property. And so obviously, once we sold the asset, we had to also extinguish the funding mechanism. So it's but the way we did it is, we just had one, what I'm going to classify as a co-investment partner alongside us, and we use a pref share which kind of cap the upside that they would that would be due to them from the investment. So if we had gone through with for example, changing from or executing, let's say, another One Belmont type asset on it, then similar to how you have in One Belmont, that structure was we use a joint venture. In this structure, we use a pref share with one co-investor. But we sold it, we ended up selling the asset rather than doing a development. And so once we extinguish the asset, we had to obviously pay out the pref share investor. But good question, a good observation, I should say.
Thank you, Jason. So we have one final question, and this one is in relation to some of the future plans for SRF. SRF's dry powder is currently below 100 million Jamaican dollars. What are, or is SRF engaged, in active plans to do another fundraise of debt in 2025 or into 2026 to shore up the balance sheet and prepare for the second investment cycle?
So very good observation and good question. So the clarity on that is over the medium term, we obviously are will be constantly raising capital, right? However, we are also constantly exiting assets, and therefore we're gonna have a mixture of, based on the timing of when we exit certain types of investment assets, we use that capital to redeploy into new investments. And if we need to fund new investments, then we will utilize a mixture of debt and some of the cash that we have from our exits. What we are likely to do, though, is we may not come back to market in the very short term for a big capital raise, right? As I said before, just so the example that was raised just now on Hillcrest, right, where you would have seen that pref share. We have many co-investors who will participate in transactions with us, especially when the value of those investments are, what I'm going to use the term, are quite lucrative for the co-investors to participate in. So we have various funding channels that we can tap, and in the near term we'll utilize capital from exits that we have that are continuing, as well as co-investors that we have been working with since the inception of SYGNUS Real Estate Finance, to fund any near-term investments that we have. And for the very large transactions that we have to fund, what we like to do is fund those on an individual basis, right? So once we are doing any debt financing for any major project that we are doing, obviously we'll make that known to the market well in advance. But good observation and good question.
All right, thank you very much, Jason. So we are now at the end of today's earnings call session. We want to thank everyone and extend a big thank you just for joining us today and getting some insights on the performance of SRF as well as the future plans. We do encourage you to read the published quarterly results alongside the audited financial statements for the year ended August 2024, as well as the management discussion and analysis. And just to repeat, these documents can be located on the Jamaica Stock Exchange website or on the investor relations section of SYGNUS Group's website, and that's www.sygnusgroup.com. In addition to that, a recording of the earnings call, as well as a copy of the presentation that was shared today, will be available sometime later today on the investor relations section of the SYGNUS website. Once again, thank you for joining and have a good day.